Look at the frenzy of any global trading floor, and the immediate impression is chaos. We see a flood of disjointed data, high-stress decisions, and raw panic happening in real time. This is a daily line chart of the Dow 20 bonds. To most observers, this image perfectly visualizes that floor-level panic. We see erratic spikes, sudden drops, and a jagged, unpredictable spread of daily price fluctuations spanning several years. Beneath this daily noise, markets operate in a continuous state of dynamic disequilibrium, characterized by a series of successive waves. If we strip away the minor daily fluctuations and connect only the major peaks and troughs, a clean geometry begins to emerge from the noise. A trend is defined by the geometric relationship between these successive peaks and troughs. Deconstructing price action into its base components, horizontal support, resistance, and angled vectors, maps the underlying psychological forces driving the market at any given time. Chart analysis provides a framework for identifying structural shifts in capital flow through the lens of price geometry. This chart displays the baseline market states. Top, an uptrend, is a series of higher highs and higher lows. Middle, a downtrend, is the mathematical inverse. Bottom, when prices move in a flat, horizontal pattern, the market is sideways, indicating a relative balance of supply and demand. These three directions are layered on top of each other in a fractal nature. Market movements contain trends within trends, highly dependent on the observer's specific timeframe. This chart displays a major long-term uptrend, marked by points 1, 2, 3, and 4. Zooming in on the corrective phase from point 2 to 3, we see it contains its own distinct near-term downtrend, made of smaller descending waves A, B, and C. Because of this nested structure, an asset can be simultaneously in a major multi-month uptrend while experiencing a near-term weekly downtrend. Therefore, any analysis of a trend must begin by defining the specific time frame and the degree of the fractal being observed. Shifting our focus from the direction of these zigzags to the horizontal barriers they create allows us to define the bottom troughs as support and the upper peaks as resistance. This chart shows a rising support level. Look at points 2 and 4. A support level is a localized zone where buying interest is strong enough to overcome selling pressure, halting a price decline. This floor holds because of the behavior of three psychological cohorts: the longs, the shorts, and the uncommitted. The longs bought near the bottom and are currently in profit. Regretting they didn't buy more, they eagerly await a dip back to that support area to add to their positions. The shorts bet against the market and are losing money. Praying for a dip back to that same line just to exit at break-even, they must issue buy orders to close. Finally, the uncommitted are traders who missed the initial rally. They resolve to buy the very next dip, joining the other two groups. The overlapping motivations of all three groups, driven by greed, fear, and regret, create a concentration of buy orders at a specific coordinate. The strength of this barrier increases based on the total time the price spends in that zone, the volume of units changing hands, and how recently the trading activity occurred. Support and resistance levels represent the measurable aggregation of human capital and emotional regret mapped onto a chart. We must now consider what happens to that aggregation of capital when the support floor finally cracks. This chart demonstrates a market decline decisively penetrating the previous support line at point 3. This triggers a phenomenon known as role reversal. When a support level is broken by a significant margin, it becomes the new resistance ceiling. The mechanics driving this flip are tied directly to the highly leveraged nature of futures and financial trading. Traders cannot afford to sit on mounting losses indefinitely. The longs who bought at the original support are now trapped. Driven by margin calls, they are forced to liquidate, meaning they must sell the moment prices bounce back to their entry point. This daily bar chart of the Nasdaq 100 index shows this trap playing out in reality, separated by several months, where a prior resistance peak acts as a floor of new support. A broken line on a chart persists because trapped capital flips its vector, transforming a historical floor into a newly reinforced ceiling. This chart plots an upward angled line, moving our focus from horizontal barriers to vectors. This is the trend line, and it measures the market's specific rate of speed. Drawing them requires geometric discipline. It takes exactly 2 successive reaction lows to draw a tentative straight line. However, that tentative line is useless until it is successfully tested by a third touch and a price bounce, confirming its validity. This brings up an analytical question. Should the line connect to the closing prices or the extreme highs and lows of the day's trading? This chart shows the correct drawing of a trend line. To account for all market activity and true liquidity limits, accurate vectors must encompass the entire day's price range, including the wicks. This exposes the trader to the danger of whipsaws, minor intraday penetrations that briefly break the line but close back within the direction of the original trend. To filter out this noise, analysts apply defensive parameters. They require a price filter, like a 3% penetration rule, or a time filter, requiring a close beyond the trend line for 2 successive days. Trend lines are geometric hypotheses. They demand empirical testing and filtered confirmation before a trader risks capital on them. We can now bring these geometric concepts, fractals, role reversal, and trend lines together to analyze a complex market reversal. This diagram illustrates the fan principle. It is the visual footprint of a dying trend. Notice the initial violation. The primary steep trend line, line 1, is broken. The market slows down, and line 1 immediately reverses roles to become a resistance ceiling for the next peak. Because the market is still trying to rally, a new, shallower support vector, line 2, is established to keep the uptrend alive. Then we see the second failure. Line 2 is broken, and it too flips from support to a resistance ceiling. The drawing and subsequent breaking of the third and final line signals the structural breakdown of the entire market movement. This daily bar chart of the US dollar index displays this theoretical geometry against an asset experiencing a shift in momentum, with the broken uptrend line acting as a resistance barrier on the next rally attempt. These repeating patterns reflect the consistent mechanics of market participation. The lines hold because of the physical realities of trading, trapping immediate selling. Reading a chart reveals the boundaries of human conviction and the current limits of market liquidity.